This episode of the AltCo's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the AltCo's Mainstream podcast. Today's episode is with someone who is an expert on the RIA market and the wealth management business model. We talk with Karl Heckenberg, the president and managing partner of Constellation Wealth Capital, an investment firm that recently closed on a $1 billion debut fund dedicated to providing differentiated, long-term capital solutions to well-positioned independent wealth management firms in the $8 trillion and growing wealth management sector. Karl's deep experience in wealth management as both an investor from his time as the CEO of Emigrant Partners and its affiliated company Fiduciary Network, and time on the advisor side at Merrill Lynch, A.G. Edwards & Sons, Wells Fargo, and Charles Schwab, put him in a position to understand the inner workings of the wealth management business. He's also sat on the boards of Sarasota Private Trust Company, New York Private Trust Company, and Cleveland Private Trust Company, and is currently on the board at Alternative Fund Advisors. CWC has made investments into some of the industry's leading wealth management firms, including AlTi Global, Cresset Partners, AlphaCore, Lido, and others. Karl and I had a fascinating discussion about the evolution of the wealth management industry and why it's become such an attractive investment opportunity. We discussed the intricacies of business growth and serving clients, why private markets are such a critical component to differentiating a wealth management firm, why we'll see a $1 trillion wealth management business in the coming years, and the parallels between the business evolution of alternative asset managers and wealth managers. Thanks, Karl, for coming on the show to share your wisdom and expertise at the intersection of wealth management and private markets.
We're going mainstream.
Karl, welcome to the AltCo's Mainstream podcast.
Thanks. Good to be here.
Pleasure to have you. I think you have such an interesting background, and you're really operating at the intersection of two converging trends. The world of private markets overlapping with wealth management. Your firm effectively embodies that. You're investing in wealth managers as an alternative asset manager. So much to talk about. Would love to start with your background and how you've seen the wealth management space evolve over time to then deciding to start Constellation Wealth.
I started, I guess, 27, 28 years ago, actually on the direct lending side. So leverage finance, Merrill Lynch, focusing on wealth and asset managers, which I always joke was the short straw at the time, because in the mid to late 90s, everybody wanted to focus on tech and companies like Yahoo and so on. Pretty sleepy industry, mostly dominated by banks, broker-dealers, regional BDs. And then really ended up through kind of a career on that side for about 10, 15 years, moving to the equity investing side, worked for a family office in the Midwest. And then in 2017, I met Howard Milstein, who's the chairman of Immigrant Bank. I was lucky enough to step into a position with Immigrant that they had an operating business. One of the pioneers in the space financing RIAs was a business called Fiduciary Network. That business had invested in about 14 RIAs over about a 10-year period. And when I was lucky enough to kind of step in and take over, the business, particularly around that time, 2018, 2019, was really rapidly shifting. You had a few financial service funds invest in the space. You had people like Lee Equity and Edelman. You had the first dollars coming into Hightower in 08, 09. So one of the things I observed when I was at Immigrant was space was obviously growing rapidly. It was getting big very fast. It was outgrowing, I think, most capital providers. And really the idea of starting an asset management firm focused just on private wealth firms, or RIAs, as we call them. Our focus is predominantly North America.
There's so much in there to unpack, particularly the evolution of the wealth management space and how firms now operate and who invests in them. I'd love to hear your perspective from you've been working with the wealth channel for quite some time. What was it like in the early days of lending to these wealth managers? And what did that actually mean then? And what did you take with you to now apply to today's world of wealth management?
If you really go back 15, 20 years, it was predominantly asset management. It was usually liquid asset management, and then it was regional broker dealers. So people like the Bairds and the Janneys and so on. And then, of course, you had the larger firms like, Merrill Lynch and Payne Weber and all those guys. RIAs themselves really weren't on anybody's radar, to be candid, until I would say really post GFC. And prior to that, I think there was a sense, even as a lender and working in the space in the 90s and 2000s, that, and it's heavily biased because I was at a large wirehouse, right? But it was really anybody that was independent, frankly, couldn't get licensed at a Morgan Stanley or Payne Weber or something like that. And I would say the early RIAs that really got set up in the 80s and the 90s, these guys they were almost missionaries. They believed in the fiduciary standard. They didn't like the conflict of interest, but they really weren't setting out to start businesses. They were setting out to eliminate the conflicts and serve their clients. And so it was a channel that I think everybody kind of looked at, but at the time, a large firm might be $1 billion. Like it just, there wasn't any size and scale in the space. I think post GFC, one of the stats that I always use when talking to investors is there was a survey years ago, and it said something like 90% of Americans distrust financial institutions, and yet something like 92% trust their financial advisor. Right. Which you can get into the whole where I think AI plays into this and why I don't think it's as disruptive to how wealth management is sold in the US. But I think really it was really that 17, 18 period where private equity started to accelerate in the space. You started seeing a lot of the bigger firms really, really get size and scale, high tower focus, all those different businesses. So it evolved to being on nobody's radar, especially financial service sponsors. Nobody was really paying attention until I think Edelman Financial Engines. And then you had other trades that kind of happened really in kind of the late teens. And then now it's all anybody's focused on. And I think there's a lot of good reasons why. I think there's some misunderstanding from most sponsors of the space. And I still don't think they really fully appreciate it. But we've also had 20 years where everything has worked, right? Like public equity markets have worked, rates have
Yep.
been low, everything's worked.
And all those things are related to the wealth management business and what they're indexed to. I want to get into that
Yeah.
in a bit because I think that gets into the investment thesis around wealth management businesses.
Yeah.
But first, I'd love to unpack something you just said, which is you're not sure as to whether the different sponsors understand the wealth management industry. I'd love for you, given that you've seen so many different types of businesses within wealth management, to break down what the independent wealth management space really is. What does that look like? What are the different types of platforms and players, and why do they exist in the way that they do?
It's really hard to get data around the RA space, even if you're looking at like Cerulli. So I think the larger macro, and then I'll kind of drill down into what we're focused on. But the larger is there's, depending on who you believe, there's 70 trillion of wealth in the US. Half of that's institutional, half of it's private. The institutional side is only growing 4% a year. Kind of private wealth is growing at 8%. So that part of the 35 trillion is getting larger, much faster than institutions. And then I think as we think about that 35 trillion, there's about 8 trillion that's managed by what we would call RIAs. Now, it's a broader term, but I think that channel is 20% of private wealth. It's growing the fastest by far. I think that's a lot of the big thesis on it, which is the US is going to get wealthier. I think you can ask most investors that if they believe that over 10 years, they'll say, yes, I think the US is going to get wealthier. And then you kind of drill down into those channels. I think within that, you do see a lot of noise in the data around what an RIA is. So is it duly registered? Is it fee only? Is it sometimes you'll see the RIA of BDs or regional broker dealers or independent broker dealers aggregated in that. So what we really focus on as kind of the first issue is where's the majority of the revenue from the firm coming from? And that should be AUM billing. So not products, not other kind of certainly commissions or anything like that, like very transparently charging a retail client a single fee based on AUM, could be flat fee, but we don't really see flat fee taking off. And so within that, I think there's about 8 trillion. Of the 8 trillion, what's interesting is 72% of that is controlled by firms over $1 billion. So there's 16,000 RIAs in the US. There's like, I think there's really about 1,000 to 1,300 that are over 5 billion. And those are the firms that still control 70% of that 8 trillion. So the space is rapidly expanding. I think to the winners accrue the AUM. I think, we'll see $1 trillion independent wealth platform probably in the next 6 to 7 years. And I think that's going to be similar to when Blackstone crossed $1 trillion. I think that's really going to be when the bell gets rung in terms of really everybody recognizing that this is a legitimate channel and that you can really compete with the wires and so on.
I think that's such an important explanation of the space. And you've done this visually on your website of this like overlapping set of concentric circles of the total AUM around 8 trillion, like you say,
Yeah.
and then the number of RIAs representing a billion AUM and above. And then you also talk about that there's going to be double the number of $1 billion plus RIAs over the next 3 to 5 years, roughly speaking. Why is that the case? And why is capital aggregating at the scaled platforms and firms, like you say?
It's a couple of things. I mean, one, I think even if you took private equity influence on the space out of it, you still have, and part of this again goes back to GFC, which is when I started at Merrill, there used to be a multi-year long kind of training program for whether you were in credit, whether you were in private wealth. And really post 2009, we stopped training financial advisors. And so and then when firms wanted to pick that back up, we had another bubble. So we've kind of gone through these periods where we've really been largely not training new advisors in the space. So what we have is, and you see this in CFA and CFP data, we have much more advisors over the age of 60 that hold those credentials than under the age of like 40. We have a huge gap in the 40 to 60-year-old range because of that. And so I think that one, advisors need to sell their businesses as they get old and they're approaching retirement. Older advisors still control the majority of assets in the country. And then I think you do have much better availability of capital, whether you're talking about equity or debt capital to RIAs. Years ago, there used to be a couple of lenders that would lend to the space. And I think those guys, similar to when I started, understood these are amazing credits. These are great businesses. And it's durable cash flow, it's high recurring revenue, it's good margins, like it's all these great things. Nobody really wanted to lend to them because most direct lenders were focused on finding people that had 50 million of EBITDA. And well, there's only so many RIAs that actually have 50 million of lender EBITDA. So I think that is certainly pushing. We put an economic value on even small advisor practices. And right now there's, I think, 75 sponsor-backed aggregators in the market that really are running. And most of that is coming from growth equity funds, which are shorter hold times and really largely levered to M&A, which I could get into why I think M&A is important, but it's not the foundational to our investment thesis. Because I think that gets into some of what you were talking about, where I think there is still a bit of a disconnect between most sponsors' understanding of the space and what a good outcome looks like. And also, I think what the real risk is in the space is, like I said, last 20 years, everything's done well.
I'd love to unpack that because I think that really does get into not just how the growth of these firms is being financed, but the difference in these firms.
Yeah.
How would you think about the difference between the platforms, the high towers, dynasties, focuses versus other platforms like Cerity or Rockefeller? And again, this is not exhaustive list. And then you have like the merchants, et cetera. How do you think about this whole space and the different ways in which firms can grow and scale their business?
I think the firms that do the best, I think the firms that are most likely to go public in the future, which I think we do need to see some public market exits, are going to be the firms that really have had a strong discipline over the last 10 years of acquiring the right businesses, making sure they culturally fit, making sure that from a service model perspective, they fit. And really, the client experience, whether you're in Charlotte or Wichita or San Diego, feels like a single firm. And I think good, bad, or indifferent, like that is the wirehouse and the bank experience, which is if you walk in those different cities, you probably feel like you're in a Merrill Lynch branch. I think RIAs who've been very disciplined about that have very good businesses. They have what I would consider more of a partner mentality. People are not just employees. They feel like the client service and so on is uniform. And so the founding advisors, the lead advisors, as they transition out and they retire, they can be serviced effectively by a number of advisors internally, and the client's not really going to feel a disruptive experience. I think the people that have like nailed that have been the big trust companies. So Bessemer Trust, Northern Trust, people like that, which is, I think, why you have multi-generational clients. I think that we have seen, because everything's gone right, I think we've seen a lot of stuff just Frankenstein together. A lot of businesses bought, not a lot of focus on back end integration. I think that's going to be challenged. And I think we're already starting to see that in the financing market, where I think lenders and equity investors are starting to kind of lean in and really try and better understand, is this a business or is it just a collection of businesses, and you're arbing the delta between the platform and the sub acquisitions? And we've needed to see that for a long time. It's just, again, we've had these equity markets that have covered a lot of, I think, mistakes. I think the firms that we focus on and what sponsors should be focused on, and I think we're starting to see an acknowledgement of this, is firms that have that consistent client experience, firms that feel like one firm, no matter the office.
Is that something that's easier to do when serving a particular client type, or does that get hard? So like you look at like the creative plannings of the world or the Mariners, those firms have scaled to 200, 300 plus billion. They're the firms that become the $1 trillion
Yeah.
platforms
Yeah.
sooner rather than later. But when you think about the type of firm that is able to create that really high quality client experience, also integrate other advisor teams, perhaps because they know exactly who their client is, and those advisors can integrate right into that platform. What works and what doesn't in this space?
I think that's right. Usually, our advice to any firm that we're invested in is, look, if you're an ultra high net worth firm, that's great. Lean into that and build an authentic client offering around that experience. And then also only recruit in or buy firms that resonate with that offering. Like they feel like they could be partners even before the transaction. I think where firms get into dicey scenarios is they try and cover the waterfront. They're like, well, we're going to have a family office offering, and it's like when you get into the data, you're like, well, your core client's $2 million. How does that work from an investment management standpoint? We can get into alts and all that later, but like, how do you manage that? Whereas I think firms that have really stuck to their knitting and had discipline around, how are those kind of acquired firms managing money? How are they servicing clients? How are they paying their advisors? How are they equitizing their advisors? I think the ones that have discipline around that, I do exceptionally well in my experience. It's easier to maintain a good margin, and that gives you a lot more options than firms that kind of take the shotgun approach and just say, oh, we'll figure it out on the backside, which I just don't think resonates and works. And then if you do win those processes, you're the buyer who is the least discerning. And then I would say you end up with sellers who are probably mostly focused on price and not building a good platform for their clients and younger advisors as they transition out.
I think there's a really interesting concept that's embedded in here in what you're saying, which is the nuances of these businesses. So I think we can both agree that wealth management businesses are good businesses.
Yeah.
Now, there's nuances within that. Certain firms have better businesses than others, better margins than others for various reasons. But how do you think about the interplay of firms being good businesses versus firms being good investments?
So where we kind of start is looking at a couple of different things. So I think understanding how the firm is growing. So net of market, net of M&A, are they able to grow same store sales? How diversified is that growth? Not only by advisor, but then also digging into where are those new clients coming from? Was it just a custodial referral program, or is it a combination of they have a lot of different on ramps to onboard new clients? The other thing that we look at, and I think we spend more time here than most other investors, is how diversified is the ownership of the business, and how does the firm aspire to have a more diversified ownership base amongst its partner group? I'm not talking about outside investors. And I think that's where you see really exceptional firms distribute ownership. And I think it's not surprising. The more people you make partners, the faster the firm grows. And those are not just advisors, those are non revenue producing employees. They should be equity owners too. Not all of them, but I think as these businesses institutionalize and become, more larger, they need to think about equity ownership more broadly. For me as an investor, that's what creates downside protection. It's not the structure or all the other things. I think that's helpful, but what really matters, and I think this is the disconnect, or at least my version of the disconnect between what's happening largely in the market and where it is what I want is I want a seller who says, what is the least amount of my company that you will buy to stay interested in it? That's a person, they have an option to do a controlled transaction the day that you invest or to do a minority. If they really believe in the future of the firm, they will want to do a minority investment. If they believe that it's just too much to finance and so on, and there's a lot of good reasons to do control investments, they'll sell control. I would say most sponsors come in and go, how much of the equity can I buy? Because as you are articulating, they are great businesses. They're very valuable and they're wonderful. I would say that creates a misalignment of incentives, because if the guy who built the business, grew it, scale it, it was his only child for 20, 30 years. And this is where it is different than GP stakes. The founders of these businesses, 95% of their net worth is in the equity of the business. This is very different than GP stakes in that regard. So if that guy is putting his hand up and saying, I want to sell the whole business, you should probably be paying attention to that. And we do try and provide and give some guidance to our firms who are doing sub acquisitions around what to look for in those deals, and to make sure when they're doing sub acquisitions that they're creating new partners, they're creating good incentives, as opposed to just buying that dynamic where, not surprisingly, the growth's going to stop, the guy's not going to show up to work, and all those bad things. So I always joke, and you can do this in Arizona now, but I always joke to LPs, like, nobody's suggesting that we roll up law firms, right? Like, if you cashed out the equity for some of these global law firms and took all the equity from the partners and then expecting them on Monday to show up and start billing at the same level that they were billing at pre-transaction, I think it's safe to say you'd be pretty disappointed. This is not that different. And I think that's where I think the value for these businesses, because you do have a lot of wind at your back, you do have market, you do have a growing TAM, you've got firms that have identified that they can grow net of that with not a lot of M&A. And so I think that's just where we're different. I think a lot of sponsors come in and they go, well, is this a good M&A platform? And it's like, well, yeah, but if you're just growing through M&A, there's 70 other guys out there that are trying to buy the same assets you're trying to buy. And so it's like having a one-legged bar stool.
Does that manifest itself in the fact that the types of firms that you ended up partnering with and the types of firms that you have worked with are high quality blue chip firms? Many do alts, which we'll get to. And I think that's a piece of the puzzle here.
Yeah.
But do you end up working with a very different type of firm than many of the sponsor backed platforms are working with?
Yeah, I think a lot of the sellers that we end up partnering with, they may have looked at a controlled transaction, but really I would say 70% of the time they've made the determination that's not for them. They need capital. They do need to de-risk a little bit. And I think in the right balance, we've actually seen firms grow faster post founder taking some risk out. When you're in your 50s and 95% of your net worth is in a single asset, it's hard to take risks. And I can sympathize with that being 50. But I think that these firms are focused on client experience. They want the client experience post capital coming in to be the same for their clients. They want their employees to be happier because, again, in these transactions, the proceeds, and it's really secondary. I don't lie to people. There's not a lot of primary in this space. It's not going to the entire organization. It's going to generally a small group of owners, and so therefore, what do the other employees get out of it? And what they want is a stronger foundation, a path to partnership, a larger, more stable business. And I think that's what we try and provide, because certainly half of our business is providing kind of minority structured capital to these businesses. The other half is our advisory team, who's led by a woman named Lisa Crawford. And Lisa, post closing, is just working with these firms to figure out, how do you make more partners? How do you think about technology? How do you think about operations? How do you think about accessing private markets? And I think that's kind of the deep value add expertise that we try and bring in. And we want partners who want those services. If somebody's like, I want the money, but I don't want your advice, it's probably not a fit. And there's plenty of other people out there that I think would be happy with that trade.
What's fascinating about what you just described is that this seems a lot like GP stakes in its earlier days,
Right. Yeah.
and what Blue Owl had to do very early on of, we need to work with the best firms.
Yep.
How do they think of it as a, Sean Ward said this from Blue Owl said this on one of the earlier AGM podcasts, of, it's a cash in, not a cash out.
Right.
And that's how you grow.
Yep.
But it seems like, yes, I appreciate the distinctions that you made earlier around GP stakes and why this is different from GP stakes. But it does seem like there are a lot of similarities with this too, in terms of the types of firms you're working with, high quality blue chip firms. They want the capital to grow, but they want a minority investment, not a majority investment.
Yeah, there's probably more similarities than dissimilarities. I was making the distinction more around kind of the net worth for the individuals. But yeah, I do think it's an opt-in. Even if you go back to Credit Suisse's old AMF financing business, I think these businesses do need capital. They do have partners that need to retire out. They have other capital projects. So they do need to find a way to access the markets without selling control. And this is where I think there's another similarity to GP stakes, is partners, because the majority of their income is coming from distributions on the equity, they're very debt averse. They won't lever a business if it's a partner controlled business to 7 or 8 turns. You will see that in sponsor controlled platforms, because the sponsors have created this kind of option for the management teams where it's kind of like a call option on the growth of the business. I think with something where 50-70% of income to the partners is coming from distributions, they're not going to lever up 3, 4, 5 times to cash out a partner or to do this. It is much easier. But I think also similar to GP stakes, when you can raise equity capital at the levels that RIAs and GPs can raise it at, it's actually pretty efficient to raise equity capital in relation to just levering the business up. And there's a balance, but I do think that there's a similarity there with GP stakes.
On that last point, why is that the case?
The multiples in the space are high. I think you can value the business similar to GPs. These are very durable businesses. They don't have a lot of, even during COVID, I could tell you, I mean, 2020 was kind of a weird year, but I will tell you, if you looked across high growth firms in the space, most firms, there was one bad quarter, but for the most part, revenue was up mid 20s, 30s. The better year for a comparison is like 2022, when everything was down, right? Fixed income markets, equity markets, everything. Most of the firms that we were working with were up single digits, but they were still up when markets were down 20+%. So these are durable businesses in that regard. And I think GPs are very similar, and that's what's attracted people to GPs. I think one of the differences that we hone in on, because sometimes LPs, asset owners, are looking at this is similar to GP stakes, is I think, and we'll get to it, but I think the opportunities for exit are much more aligned than they are on maybe the GP stake side. Going back to just that one point, which is majority of the net worth is tied up in the equity. So there are no carry pools for these businesses. So when founders do get to a certain point, and high growth can be, and I think you see this in GP stakes, high growth can also be a curse because it means the ownership is getting even more concentrated because you can't finance it fast enough to keep up with a firm that's growing at 30, 40, 50% a year. And I think that that provides us a little bit more line of sight on exits because those founders are going to be very incentivized to figure out a solution to get liquid on it.
You mentioned the word, we have to talk about it, exits in this space. So I think there's a few preceding points as we get to the topic of exits here. As you know and have mentioned, valuations are starting to get higher in this space. Sponsors are driving that a bit, particularly with the blue chip firms. The valuations are significantly higher than other firms as well. There's new capital providers coming into the space, whether it's large private equity firms, sovereigns, insurance companies, et cetera. How do you think about the exit environment unfolding in this space, both in terms of Constellation, because it feels like you're sitting in a place in the market where you can exit to some of these either larger platforms or sponsors or other types of investors, but then more broadly in terms of the space and how the space maintains the types of multiples that it has.
Yeah, so I'll have to bring you on our next fundraising roadshow. So that's right. I would say we do focus on firms. I think if you have an entry valuations, kind of call it sub 3 billion, it's much easier to provide line of sight to LPs and to yourself to say there's still a private market financing solution if that firm doubles or triples. I think, especially if you get into this like 500 million to 2 billion, like that, I think that's easier. I think where people are starting to get pushed is on the $5-10 billion valuation firms. Like, okay, if they double, like, what does a public equity multiple look like? We don't know yet, but we kind of have a couple of different comms that we can use. I think in our space, the one good news is, as you said, there is a lot more capital coming into the space, which means that a lot of those platforms are getting bigger. And in order to maintain some level of inorganic growth, the size of the assets that they need to buy is getting bigger too. So you mentioned Passstone, and I was invested in that business at one point. Fantastic business, but they bought Hall Capital, right? And I think when you look at that, it's a great transaction. I think it lines up well for both firms. That's not a transaction you would have seen 5, 6 years ago, not at that size and scale. And I think now you're going to see a lot more of that kind of elephant hunting. And part of that is going to be, hey, if we want to grow at 20% inorganically, we need to take in $20 billion of firms. We can either do it through a couple or we can do it through 20. The amount of work is roughly the same, size agnostic. So I do think that there is plenty of capital to come in to continue to finance out kind of, as we think about entering and then exiting. I do think the larger platforms, and we've heard this from some of the sovereigns and some of the larger investors who invested in the really big guys. I think their focus post-investment of the ones that they made in the last year or so is really going to be thinking about a public market exit and how to prepare the company for that. And that's not work that has been done in these companies over the last 5 years. Like nobody has ever uttered IPO in this space. Last time it was uttered was Focus and Hightower in like 2008. Focus did it. Now they're private, but Hightower talked a lot about it 14, 15 years ago. And I think they've stopped talking about it. And they're not alone.
You probably have an interesting perspective on this, and obviously not sharing anything you can't share, but you're an investor in the one pure
Yeah.
play publicly traded wealth management firm and alts business, AlTi Global alongside Allianz. But it is interesting to think about how this evolved. Like, do you think that these larger platforms will go public, or is there more of a permanent capital solution for those firms so that they can continue to stay private and just continue to grow, but there's still a way for them to finance themselves?
I think it's going to have to be both, which is there are only so many global sovereigns that can afford to write, what in the future could be 10, $20 billion checks. So I think that there will be some. You saw that with Fisher. I think their intent is to stay private, and I think it likely will, and they'll find plenty of private market support. But I also don't I think that's going to get into a conversation. And same thing with CVs. CVs don't trade at the same multiple as kind of assets outside of a CV. So what does that mean? What does that mean to the entry price? What does that mean moving the asset in? And I do think that there are going to have to be some firms that go public. It was just, even if you say they can get away with it in the next financing round, I think if they raise money at 20 billion, if they keep growing, I don't know that they can be private at 40 or $50 billion TEV. And I think somebody's going to have to be the first guy really through the wall on a large scale kind of public company. And I think the more that we have public comps, I think the better it's going to be. It's just, I don't think anybody really wants to be the first guy through the door IPOing that business. So it'll happen. I just think it takes a lot of work, and public markets are tough, especially. I think the bar is moved where it used to be 5 billion, and I think now people kind of look at 10 billion as that, and we've seen that in the private markets when you talk about companies like Blue Owl or others who are public. I think it's much easier to get attention at 20 billion of EV than it is at five.
Well, another interesting point in the context of this topic, not directly related, but somewhat related, is that these businesses really do compound over time. And I think depending on how you structure the investments, I think this is how you structure the investment, but the return on investment, particularly the yield that you generate on an annual basis, it actually goes up as the AUM increase. That's the beauty of this business that I think you certainly have understood and captured. And that's part of the magic of all of this is as these businesses grow, either organically or through acquisition, through the markets continuing to perform well, if you structure the investment a certain way, you generate greater return on capital invested than you would
Yeah.
in year one.
Yeah. Well, yeah, and I think that going back to the law firm analogy, firms are now getting to the point decisively, even large scale platforms, where they realize they have to start making distributions, or at least in my opinion, they do, and I think a lot of the firms agree, because you can't just be locked up in equity that doesn't pay a distribution, has no line of sight to liquidity forever. That's a recipe for people leaving, and that's scary too. So you have to find this balance from an investment standpoint. I think you're absolutely right. I think the way that, coming from a credit background, the way that we always look at it is this what we would view as an investment grade kind of asset, and then what is the equity return profile? And I think if you can answer those two questions, then I think you can feel pretty good. I think that's why we were able to have a very successful first fund at size, which is kind of that approach, as opposed to putting a model in front of LPs and saying, well, if multiples go up even more and margins expand and equity markets return even more, and like everything has to go right. Whereas to your point, like if you say, hey, look, growth rates can slow down, margins can slow down, all these things can happen, but you know you're going to be okay if you hold the asset for a long enough time. I think that resonates with people, particularly in this environment. But then it's also going back to that: is there a legitimate path to exit these businesses? And we are very fortunate that I think a lot of investors, either through fund investments or co-investments, have seen the amount of capital that is coming into the space. So I don't think they necessarily worry about, are you going to be able to get out?
When you talk about investors looking at the space and working with you in particular, you mentioned that there's some element of a credit like investment in terms of both the underwriting, that's your background too. Where do investors bucket this investment? Is it a credit investment? Is it private equity investment? Is it opportunistic? Is it something else?
So literally all of the above. It depends. I think most people it fits into kind of the equity bucket, right? Because of the returns. We have seen it in private debt allocations from LPs. Most of our investor base is institutions. So longer duration capital, I think flexible. I think less constrained by like what bucket does it fit in. I do think that, and I'm sure we'll get to it, like, I do think that that's something that we provide a lot of counsel. If I had a nickel for every time I talked to an asset manager about penetrating private wealth, I wouldn't have needed to start Constellation. But I think that that bucketing approach is really important in private wealth, because those allocators are very hyper focused on where does it fit? What does it supplant? Institutional investors are a little bit more flexible.
It's really interesting to think about that. But also, when we talk about LPs, the synergies that are there with your LP base, I imagine some of the institutions or even asset managers, if you have them as LPs, the synergies that are available to them working with your network? I think you mentioned, Lisa, you've built out a whole platform team too to be able to help these businesses. I'd love for you to discuss the network effects
Yeah.
of the LP base you've built, and also just the network effects of the advisors themselves, platforms they've built. I imagine there's shared synergies amongst the entire group that you've brought together.
So I'll start with the latter and then move to the former. So I think with the firms that actually becomes it's interesting. It always is an initial hesitation to doing a deal with Constellation. It's a question that comes up a lot. And then, my advice always has been for a long period of time, call the CEOs, managing partners of, the 9 firms that we've invested in, right? Talk to them about it. Are there conflicts on the M&A side? What is the value add of the advisory team, the network? That's actually where I think they get sold, so to speak, which is I'm not going through this alone. Like I may feel like, and I always say the RIA industry is actually a very lonely industry because you may be $5 billion, you might be in Puxatawny, Pennsylvania. You're probably the only $5 billion firm within 100 miles. And you don't have time to go to Impact or go. And even if you do, nobody else looks like you because most of those firms are 300 million. I think getting these firms on board we get them, and Lisa's group really gets them to start sharing within functional groups. We'll have a CTO, a CIO group, all of those people just share best practices. Hey, did a transition from this reporting system to that. What did you guys learn? Like, that's not information. We can give our opinion on it, but then it's like, hey, why don't you talk to these 2 firms who actually did it? I think that's where they start to realize they're not competing with each other. They're competing with the banks, the wires. They're competing with subscale firms. Like that's who their competition is. On the LP side, as it relates, you're absolutely right. I would say the timing of us raising a fund has been very good because everybody has had interest in this channel. So if you're an insurance company, you want to sell more products in the channel. If you're an asset management business, you want to distribute more products into the channel. And it's not about distribution. We do have to have that conversation with people up front. We're not distributing anything. This is an opportunity for you to spend time with us, LPGP, but then also separately, your strategy group and us, and talk about like, if you really want to invest in building out and winning in this space, what do you need to do? How do these guys buy? How do they think? And I think that's where there's a lot of buy-in on their side because I always tell people, look, if you look at the Blackstones and the Blue Owls and the Apollos and the Ares, they've hired over 150 people to cover retail distribution. So if you think that we're going to strike up a partnership and suddenly you're going to see, billions of dollars flow into product, that's not the way it works. But I do think that not everybody needs to do that, right? There are other ways to achieve a level of success in the retail channel without hiring 150 individuals. And so I think we kind of go through that. Is it an SMA around this product with 5 or 6 different firms? Or how do you grow with them? How do you understand the bucketing conversation? What's the right structure? Just because you think it's an SMA, they may think it's a registered product. You may be right, they may be wrong. It doesn't matter. They're the allocator.
I think you're bringing up some really interesting points. One around the fact that if firms are choosing to work with Constellation, they are getting access to a platform, particularly when they leave the wires. I think that tends to be a challenge for a lot of advisors. They no longer have the resources. And even that's why I think the other platforms that we've talked about, they benefit the advisors. Obviously, a lot of the firms you're working with have been independent for quite some time. So they've been able to, in one way or another, access some of the benefits of both being independent, but also getting access to things in an open architecture way. What do you think is most important to your affiliates in terms of the things that they can share? Is it in back office and synergies around the operational side of it to increase EBITDA? Is it access to things like private markets and different alternative investment funds as a solution that they can share, and maybe collectively they could allocate 50 or $100 million to something together and then get better terms within a fund or something like that? What has ended up being the most impactful area where platform has made a difference?
It's it's very firm by firm, and I say that because half of the firms we're invested in are below 10 billion, but then we have a cohort that are over 50 billion. So how you interact with them is going to be different than how you interact. I would say by and large, the average firm, it's a mix. I think operations. Really, it's around equity comp planning, advisor planning. I do think thinking about M&A, I think it's on the private markets, I would say what we generally find is firms are either highly institutionalized and really well built out. And I would say and this is all, I think on our website, like we have $180 billion in AUM across the 9 firms, which is on average very large. What's more interesting is over 50 billion of that is in private markets. Now, how do you cut that up and divide it? What's registered? What's a traditional type fund? Yield versus equity, all those different things. But I think firms are either highly institutionalized and really sophisticated on it, or firms don't touch it with a 10-foot pole. And I think for the firms that don't touch it, where we try and spend time, and particularly myself, and we have another woman that joined Karl and on our company on the research side, is what are ways to diversify your existing investment approach? Because so much is North America biased, equity biased, S&P 500. How do you just, in an efficient way, give the client a little bit better diversification and understanding different structures, liquidity profile, how it fits in with what you're currently doing? Obviously, private credit, private real estate is usually kind of 80% of that mind share, but approaching it that way. But with the largest of the firms, they're already doing direct investing, they're doing co-investments, they're creating their own vehicles, they're doing all that. I think where we add value in that concept is a little bit different. And we're saying, hey, look, we also know that there's 5 other firms that are doing that same senior lending fund from that GP. We're going to have a conversation with them. We don't benefit from it, but if we can drive down pricing for all of the firms and that accrues to their clients, and they love that. They go, okay, great. You just saved me 25 basis points on management fees in this because we're getting a different share class or founder shares or something like that. So that does benefit them, but they didn't really need help underwriting it or something. Other firms are like, I don't even know where to start, right? And Catherine and our team will spend more time going, here's how you should kind of think about building out that platform.
Well, when you have firms like Cresset or AlTi or AlphaCore, they certainly understand private markets. A few of them have actually been on the podcast as well. And I think that speaks to something, though, that I think is a really important question in this space. And I think will become more important as time goes on, which is how important are you finding capabilities and knowledge of private markets to be a differentiating feature for advisors to either attract or retain clients?
I do think that if you look at it, particularly over the last few years, I think for the really smart firms, it's about that point that we talked about. It's about diversification. It's just saying, here's the equity markets globally. How much is public? How much is private? How do you get exposure and then manage the liquidity? But if you really want to take an institutional approach to it, you have to access private markets, at least in my opinion. I think with RIAs, I think it's historically, up until the last few years, been the dumping around for bad products, right? So, you've had a lot of experiences where RIAs of like, I'm never doing this again. And it's, look, not all hedge funds are bad. Let's back up the truck and think about how some of these managers are now accessing the market. You're getting better quality. But I think going back to that point, I think education, and look, the Blackstones and the Blue Owls and the Apollos and Ares and Vistas are really leaning into advisor education. And I think that's something that we dramatically needed. I think it is a big point of differentiation because if you look at the private markets platforms at the wires, it's actually exceptionally limited because unfortunately they have 15,000 advisors and they essentially have to manage to the dumbest guy on the platform. It sucks, but it's true. RAs don't have to do that. They can go to a Vista or an Apollo or an Ares and say, hey, we would like to build a product. We would like it to look like this. We'd like this mix of asset-based lending versus cash flow lending. Work with us. And I think then they go to their clients and say, oh, by the way, the wires don't have this product. And if you were to compare it to a BDC that they're doing, like, here's the difference in the leverage, here's the difference in the fees. And oh, by the way, I'm not participating in any of that. It just all accrues to you. That is a huge, I'm stealing this, I think, from Cheryl Penny 10 years ago, but he had a really good one about it. He said RIAs are essentially democratized single family offices where custody, investment management, and wealth management are all separate. It's all evaluated independently, and then you do it through kind of this fiduciary lens. And I think that firms that get it lean into that. And I think you talk around fees and margins and all these different things relative to wires, but I think that's where the independent channel is winning is wires have to, from a compliance standpoint, a product standpoint, they just don't have the offering. And I think when you look at iCapital and Case and all these platforms, I think technology has been a huge game changer for this industry over the last 7 years, where the client experience can be better as a client of an RIA than it is at a Merrill Lynch or a Wells Fargo.
I think you're hitting on some really interesting points when it comes to where a certain part of the wealth channel, certainly the larger platforms and firms, are in their adoption of alts. Because you think about the platforms you just mentioned, the iCapitals, the Cases of the world, access is now table stakes. So it feels like, and we've seen this with the acquisition or partnership between Cerity and Agility
Yeah.
and at Hightower and NEPC, and you have someone from Cal, and you have these OCIO capabilities
Yeah.
at many of these larger firms where they know they have to customize. But
Yeah.
then the next challenge becomes, how do these platforms balance customization with the ability to create enough scalability so that from an operational perspective, it's actually worth their time and worth the operational overhead fees, et cetera. How are you seeing firms balance those two things?
So that's something I've told GPs for a long time they don't understand is typically the COO has a veto at the investment committee. So if you don't understand that, I don't care if you're returning a bazillion percent a year. If it's operationally not efficient, the firm's not adopting it, and you will never get scale in it. You might get a $30 million check out of a firm and it's a one and done, and it'll be an operational nightmare. I think where people have really scaled up retail products has been exactly that. And I think it's driving down the fees for the managers. So that means probably as much no fee co-invest going into that vehicle as primary fund commitment. I think it's the back and kind of middle office. I think a lot of RAs still do it themselves or they work with providers like an iCapital. But the point is those fees are coming down, the manager fees are coming down, the co-invest fees are offsetting the existing management fees, and you are able to build something. I think this is where the RE community, this is something that we lean into a lot with our network, which is just look at it from the standpoint of if you can build a $2 or $3 billion product, that's better for you. It's better for your clients. Now, can you do that all internally? Probably not. Does that mean that you might need to partner with 4 or 5 other RIAs? Like, you should do that. I understand you're saying, well, now it's not just mine, but if the fees are lower, it's just a win-win. So I do think GPs are getting savvy to this. I think they're trying to seed and anchor products within the community. I think it's still a lot of education, but I do think those prices are certainly going down.
We talk a lot about GPs educating the wealth channel and the wealth channel needing to learn more about private markets. But what it doesn't feel like we talk as much about is what you were just discussing, which is, what does the wealth channel actually want?
Right.
How
Yeah.
did GPs
Yeah.
do a good job and an effective job of making sure they really understand what
Yeah.
the wealth channel needs?
Yeah. So, I mean, it's kind of that old adage, listen twice as much as you talk. Like when you get in, and if you're talking to a firm like an AlphaCore or an AlTi or a Cresset or anybody, listen to what they're doing, what they're trying to solve for. So, not surprisingly, I think 80% of products sold into the channel are yield oriented. So, credit, real estate. So, presumably they have access and they have exposure to different large products like Cliffwater and so on. So, are you going to supplant that? Probably not. Can you complement it? Certainly. We have one GP that's also an LP partner that I would say is built a really thoughtful offering on the credit side. And what they where they've gotten a lot of traction with a lot of firms is they say here's the overlap with other top tier credit products, and it's 4%. And it goes, okay, so now it's a diversifying. It's not just like I'm leaning into the same stuff and I'm just doing it through different vehicles. But I do think you have to listen because I always counsel GPs too. When you start talking about secondaries, when you start talking about co-invest, when you talk about all these different things, your assumption is they know what the hell you're talking about. Don't assume that. Like for some firms, you will need to back up the truck and start from a different level, and you'll need to talk about liquidity, what a secondary is, what a co-invest is, all these different things, and then what it means. Because just because if it's a registered product and it has a ticker, just because you can get in doesn't mean you can get out. Like, and have that conversation up front. Talk to them about what they want, what they need, and then talk to them about just like timing. Like real estate debt is still pretty hot right now. I think we've seen a lot of products launch around that in the last year or so. But how does it differentiate? How does it, how is it correlated to the equity on the real estate where clients are reading newspaper headlines and they're panicking because they're watching another office tower get wiped out? I think it's just going back, but you do have to listen. And if you come into it with a bias, because I think most GPs are selling to institutional allocators of why their fund is the best. RIAs actually don't necessarily like that is part of it, but it's not the only part. It's are there educational resources? Will they help them with client dinners and educational events for the clients? And what are the fees? Because, fees matter and all these different aspects. So I think the ones that win listen, but then also I would tell you it's a contact sport. So if you talk to the most successful, and we talked about those big GPs that cover the platform, it's not a one and done. Like they may have with one firm over the course of a year, they may have 30 different touch points with that firm just to get a single allocation. And that is where it's full body contact. And even if you're a small firm, you still need to have that expectation because it is a little bit different than dealing with an insurance company LP and kind of going through a couple of meetings and then going through diligence and then, you're done. It's very different. It's an ongoing relationship.
So that really portends to scale really mattering in both cases for GPs and the wealth channel. And I bring that up, and I think you make a really important point because these two trends are inextricably linked, right? The growth of the wealth channel, not only the fact that they're private equity backed firms
Right.
in many cases, that's accelerating some growth in the firms, adoption of alts, private markets. And then these large firms are, to your point, size and scale as their own platforms to be able to handle what's required to work with the wealth channel, both from a distribution perspective and an operational perspective. So it sounds like there's really going to be this almost this parallel tracking of the two. Is that kind of the right way to think about it?
If you listen to the earnings calls for any of the private markets, public companies, RA's private wealth shows up on every quarterly call, and it's usually featured and even now broken out to here's how much AUM we collected in the wealth channel. Because the institutional, as I said, is growing at half the rate that the private is, and institutional is fully allocated in terms of their allocation. Retail is not. That's kind of the big hypothesis. Now, I still think you've got to stratify that and figure out this is really appropriate for people with high net worth, ultra high net worth profiles. It's not for the guy with $1 million that should have 5% in a private like that. I don't think that makes sense. So I think some of the numbers are wrong, but I do think overall, the firms that are growing the fastest tend to have the some of the higher net worth clientele versus the overall industry, and then they are, as you said, mathematically just growing the fastest.
On the wealth side, is this going to look maybe not exactly the same, but similar to the way that the wirehouses have grown into big platforms over time? Like, is this like that classic? I always go back to that chart of
Yeah,
U.S. banks, right? Like there were a ton
yeah,
of banks
yeah,
in the 70s, 80s, and then it consolidates, and then maybe there's a little bit more, but then it's really the large players.
yeah.
Is this kind of how the wealth space shakes out over time? Is we're going to get this period of massive consolidation, and then there'll be an unbundling, and then it'll just complete the cycle of life again and again?
I don't know if it gets. I think the quality firms don't get unbundled if they built a consistent client experience and all these things. I think that's one of the reasons public markets have to be a solution because otherwise the only buyers that can afford these businesses are like the cities and the JP Morgans and so on. And look, we saw that with Goldman Sachs already. That was a let's take it in and then let's
Yep. With
merge.
United Capital.
Right.
Yep.
Yeah. So that didn't work. I do think that we need to find some long term solutions for these businesses. I do think, look, I was listening to a podcast from somebody that I love. He's a hedge fund manager, and he was talking about AI and the number of AI startups. And he was just talking about the history of technology. And one of the things that he talked about is when you go back, the only thing that you can credibly say about what's happening in AI right now is, with the exception of probably one company, everybody else is burning cash that they'll never get back. Google won search, Amazon won commerce, Microsoft won productivity. There is not a huge, now within the RA channel, I don't think it's one. I think it's going to be this kind of what you said, where it's like 72, and maybe that goes up to 75, 80% of the AUM is managed by firms over 5 billion or something like that. I still think that because technology is a huge differentiator and it has allowed more of a democratization of good investment and kind of client offerings, I do think you'll always see a lot of independent advisors. We've seen that in the CPA world. You take the big four and you go, okay, well, not all tax business and audit business and all this is done by the big four. There's still a lot of independent preparers. There's a lot of these guys that are out there. I think it'll be similar to that. I think there'll be a lot of big kind of mega platforms. But it's interesting because when you talk to clients, like we still talk to clients pre-closing of the firms that we invest in, the clients actually really don't know how big the firm is. Like they know their advisor, they know that their assets are custodied at Schwab or Fidelity or Pershing. They kind of know what's in their investments, and then they know their team, and so on. But whether the firm is 100 billion or whether it's a billion, I don't know that they really care. And I think that is a little bit different than on the tax side. So it's not a perfect analogy.
Do you think a client should care how a firm is financed? Because it may not change
Yeah.
today, but it may change 5 years from now.
So I lean into this a lot when I'm talking to sellers because I do think families are underwriting wealth managers more like a LP underwrites a GP. So I get the question daily, what's my succession plan? I'm 50, still get it daily. I think we're seeing that more. I think we're starting to see particularly wealthier clients, but I do think it'll drift down to what type of capital are you taking? What is this going to mean for the business? I do think they'll get a little bit more savvy. I think we're a longer term investor. I think because we're always minority, I think that helps the conversation with the clients because we say, hey, look, we're not on the board, maybe we're an observer or something. But at the end of the day, the firm itself has the majority of the economics and the equity in the business. That's a much easier sell. And then they can talk about how bringing in this financing helps keep the firm independent and does all these things. I do think you will start to see kind of, look, we saw this with First Republic when JP Morgan bought the business after that kind of fiasco. And I think a lot of the wealth managers, when they were talking to their clients, and they are going through this consternation of crap, now I'm back in a big bang. Is that where I'm going to end up? And candidly, RAs lean into this all the time and they can say, hey, look, we're independent. That's our plan. Your service is not really going to be dramatically changed, but it's already coming up a lot more in the last few years.
You mentioned something, brand, and how a firm talks about themselves as they evolve. I want to tie that to the prior question that we were talking about, which was this parallel tracking between the growth and evolution of alternative asset managers as businesses and as they've gone public. And it feels like there's the wealth management space is following in that regard as these scaled platforms become bigger, some will go public. What do you think wealth managers can learn from the evolution of these alternative asset managers that have become scaled platforms and have become public?
It's interesting because when you look at a lot of those businesses on the GP side, what is amazing is succession planning is still the number one topic of conversation across any of those firms, whether you're talking Blackstone, BlackRock, Apollo, Ares, like they're still tied to individuals. I think the firms that do a better job will start to untangle that and address that earlier than later. I think private markets firms, I always say 10 years ago, Blackstone was the size of creative planning today. It was a conversation, but I don't think anybody was as hyper focused on it as they are today when it's over a trillion. So I do think firms, I always joke the best time to sell is yesterday. Next best time is today. You do need to think about talking to your clients about this and thinking about it. I also think staying authentic to who you are and what you do. I think different asset managers are known for different things. And I think that resonates with their LP base because that's kind of what they're known for. I think when you start to veer outside of that lane too much, I think that's where things can get a little dicey and a little bit ugly. But I think at the end of the day, it's largely about succession planning. And we saw that with the recent proposed Treasury appointment that caused a whole four-alarm fire there at a public company. So just how does that all play out, addressing it, talking about it? But I do think RIAs are not as accustomed to having to build the infrastructure that scaled private market firms have had to build. If you look at the size and the headcount and the number of high level professionals at any of those companies that we just talked about, it far outweighs the RIA space, even at similar sizes. And I think some of that is because GPs have been beat up more and conditioned more by LPs that you only get the money if you can answer these questions. RIAs don't have to deal with that. You can be a, $12 billion firm and have two shareholders. And the client walking in Wichita isn't going to ask the question. An insurance company committing to a fund managed by that asset manager is going to want to know, and they'll really dig into it. So even my journey over the last year and a half, you have to answer these questions on a daily basis, and they come up every day with every commitment that you take. RIAs haven't had to wrestle with that yet.
I think it's such a fascinating thing to think about for the future. I want to tie that to the last question that I always ask everyone, which is, what is your favorite or most interesting investment in private markets looking forward?
If I'm taking it more personally, I think I don't know if it's an investment, but I think it's more of something. I used to love the question, what do you think that nobody else really thinks? And so I like when I look at some of the hedge funds like an Elliott or by a Citadel or Millennium or so on, I think it's interesting because when you look at what they're doing and kind of the structure, it's interesting because it's almost like a UMA account. And I think, can they unbundle that and create more of these customized portfolios? I think they do it for really large clients. I actually believe it'll be interesting to see how this plays out. I do believe the lines of asset and wealth management are blurring more and more. And I do think that there could come a time where some of these large, sophisticated asset management businesses, hedge funds are a great example, where they're multiple on, valuation is probably half of what an RIA is. And do they start to unbundle that, and then do they think about expanding their service offering? It's not really an answer to your question, but it's something that I think about a lot, which is, and that's where when we talk to firms, it's like, hey, look, I think you've got to think about who your competition is in 5 years, not who it is today, because I do think that we could start to see that come in more. I do think the hedge funds will continue to do pretty well, I think, in this environment. I think private equity largely has to answer the question of how they return capital without public exits, and so far everybody's still dodging the question.
I think those are fascinating things to think about. And it kind of gets to a little bit of what we've discussed too. There's obviously different ways to finance businesses in the wealth management space or build businesses in the wealth management space. But do private equity firms or hedge funds, do they find ways to serve wealth
Yeah,
in a different way?
yeah,
And to your point, I mean, when they look at valuation multiples of RIAs, that probably strikes a chord. So I think it's a fascinating question to think about. How does this actually unfold?
yeah, yeah. No, I think that's right. I mean, we hear it from large investors that are GPs, that from LPs in our fund, and the wheels are turning. Now, it started 5 years ago with every single family office going, well, why are RIAs trading at this? I essentially do the same thing. I just need to add a few extra clients. And we've seen a lot of single family offices become multifamily offices and then pull the single family assets out. I think you'll see more of that as long as these businesses are valued on that. But I do think you could see the inverse where you start to see some of these big asset management businesses going, well, at what point do we just start adding on a wealth management, kind of financial planning aspect to what we're doing? Because we're already doing all the investment stuff. So, I, so far they're making so much money and they're so happy. I don't think they want to get into it. Hedge funds already have to deal with the regulatory side of it. So then it's a question of what would it take to build that out and so on. Nobody's done it, but it's a similar dynamic where they have so much of the AUM for the hedge fund industry relative that I would probably be a drop in the bucket for a bit.
Well, what's fascinating is many of these biggest firms on the alternative asset manager side, alt manager and hedge to some extent, they have private wealth businesses with their own CEOs,
Yeah, yeah,
and they're trying to service the wealth channel writ large. So you're prediction, I'd love to check in a few years and we can talk about this again in that regard, because I think that'll be fascinating to see.
Yeah.
And also see, I mean, the evolution and growth of what you've built in the space over your career, but also at Constellation. I think fascinating to see how this is all evolving.
No, it's been great. I appreciate it.
Thanks so much for coming on the show, Karl. This was a fantastic conversation. Really enjoyed it.
No, same.
Awesome. Thanks.
All right, thanks.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going mainstream.